Hey, it's Mike over at Cross Country Mortgage. It is Monday morning. It is time for your Monday morning mortgage update for the week of July the 22nd. Hope you all had a great weekend. I spent the weekend in Bend visiting my sister, son, and floated on the Deschutes, saw a concert, had some great food, some really good beer. Really nice weekend. Hope you had a good one as well. Let's talk about what's going to happen in the market this week and what happened last week. Always try to give you some insight so you can have great conversations with your buyers and your sellers. So last week, we saw a sell-off in the bond market. That means the pricing of the interest rate. If you're going to quote an interest rate, if we quote an interest rate to a buyer, how much is that rate going to cost? That pricing got worse by about 30 basis points, 32 basis points means 0.3%, not the rate, the pricing. So let's look at the charts. I want to make sure that you can see what's been happening over the last couple of weeks. So if we look at this graph that shows the trading of mortgage-backed securities, I show you this often. Each one of these candlesticks, because there's little wicks on these, represents 1 day of trading. It shows the movement in the full day of the market. And if we look at last week, Thursday and Friday, a little bit of a sell-off. Today we're starting out a little bit down. 2 weeks before, on the 8th, which was Monday 2 Mondays ago, we saw a nice increase in the market 2 weeks ago, and then we basically lost most of what we gained. So if we look at the last 2 weeks, we're pretty much flat. There really hasn't been much of a change. And this just shows us how much volatility there's been in the market over months. And it doesn't change. We see an increase, we see a sell-off, we see an increase, we see a sell-off. We pay a lot of attention to this with our buyers because we're advising them on when to lock an interest rate, when to get the best pricing. And so we pay a lot of attention to this, just like a stockbroker does when he watches the stock market. So what happened last week? We saw some retail sales numbers above expectations. That means that people were buying stuff, the consumers buying things, and that caused that shows a strength in the economy. And basically, rates, the money flowed out of the bond market. Rates got a little bit worse, not a lot worse, just a little bit, eighth of a point, not a big deal. But whenever we see strength in the economy, we're going to see a sell-off, and we're going to see those rates typically get worse. And as we know, these rates change multiple times in a day. I mean, I get calls from people that say, "What's the rate today? What's the rate today?" Well, the rate I give you today may be different tomorrow or this afternoon. It may be different in an hour. So rates don't stay flat over a long period of time. They are very volatile. They go up and down all the time. So what are we looking at this week? A lot of data coming out this week. Some very impactful things, but I always try to give you three top points. We've got inflation, big number coming out this week, data on what's happening in the market, and then politics. So what are these three things doing that are going to cause rates to possibly go up or down? First, inflation. We know that's the number one reason why rates are high is because inflation is up. As soon as inflation starts to taper down or get flat or even go down, we haven't seen it go down, then we'll start to see mortgage rates go down. Now, 2 weeks ago, the Federal Reserve Chairman said, hey, we're starting to see a softening labor market. We're starting to see the inflation numbers get under control. That's the sign. Starting to see unemployment go up, and jobless claims, which come out every Thursday morning, those are starting to go up. Layoffs are continuing. So this message is basically that we're seeing is indicating that maybe we're going to see an economy that's weakening, and we're going to see mortgage rates start to improve, go down. Of course, we've been waiting for rates to go down for a long time. We can't predict it. 6 months, 12 months, 18, 24, who knows? But there are some signs, canary in the coal mine, if you will, that we're starting that we could see rates come down. And the Federal Reserve Chairman indicated that 2 weeks ago, which is why we saw the market improve a couple weeks ago. So inflation is the big thing. PCE is the number one thing that the Federal Reserve pays attention to when they set their policy. And they're meeting next week, and this PCE report's coming out on Friday. It's their key measure of inflation. Yeah, they pay attention to CPI and to PPI, which came out last week, but PCE really is the big one. And it's expected to go up a very little bit, expected to go up. So if it meets expectations, that's good. That means we're not going to see rates go up. We're probably not going to see them go down. We may see them be flat. So if it's above expectations, if that inflation number goes up, that's not going to be good for rates. There'll be a sell-off. So we'll really be paying a lot of attention to what's going to happen Friday. That's when the PCE report comes out. And again, this report will be very important because the Fed meets next week starts on Tuesday, ends on Wednesday. And depending on what happens on this PCE report Friday, could impact what their policy is next week. We don't expect rates to be cut or increased. That's expected in September at the end of the year, but it'll still be an important meeting. Second thing is data. A ton of data hits the market this week. Gross domestic product. Is our economy growing? Is it shrinking? If that number is good, positive, above expectations, not good for rates. The last two numbers have not been good. So we'll see what the trend is. Debt dump. Big debt dump, billions of dollars. And what that means is the Treasury sells bonds to raise money because they got to pay their debt. They're basically selling debt to pay for debt. And bond traders and investors buy that debt up. And there's a lot of debt to be absorbed in the market. The appetite of this debt, 2-year notes, 5-year notes, et cetera, the appetite on investors to buy that debt could impact rates. If there is a very low appetite, then rates will typically go up because less money is flowing into that bond market. If there's a big appetite to buy this debt, which typically can happen if there's uncertainty about the market, then that would be positive for rates. Last thing is politics. Every single weekend, something new comes up. Of course, big weekend this weekend with Biden getting out of the race. So how does all this affect the market? Well, how does this affect the interest rates? How does it affect the Fed's decision? How does it affect inflation? How does it affect our economy? All those questions. And so it isn't so important about who gets elected. It's the party, the administration that's going to be running the show. You know, I've been doing this a long time, sending these Monday morning videos out. I think it's on 6 years. And I remember 4 years ago when Biden got elected, we were having the same discussion, the same predictions about who was going to run the show, whether it was going to be Trump or Biden. And the market is impacted by that because it's not so much who gets elected, it's who's going to run the Federal Reserve, who's going to run the Treasury, which administration is going to be pushing the buttons and influencing policy. And so with Harris and with Trump, Harris appears to be the person who's probably going to be the nominee for the Democrats. Leading up into the Democratic convention, we're going to see some volatility in the market once the Democratic convention is over and everybody knows what is happening moving forward. Then we're probably going to see some stability in how the decisions are going to be made that could impact the market. So this week could be volatile just because there was a big change over the weekend. Not a big change. It could impact it. A lot of it just depends on what happens day by day, but hopefully it gives you some insight on how this election and every election every 4 years impacts the market potentially. So what's our plan this week? We're floating into Friday. Friday is the big day with that PCE report. Obviously watching the market, locking our clients' rates in if we need to, and saving them money. If you have any clients that need help or need advice on what to do with their rates, don't hesitate to give me a call. Forward this to somebody you know that can help you. Hope you have a great, productive week, and we'll talk to you next week. Bye-bye.